The US Treasury just pulled off a bond coup yesterday by doubling long-dated debt buybacks. Washington is now trying to tame the soaring yields, especially on the long end of the US yield curve, as US debt blasts past the 40 trillion US dollar mark. Markets reacted instantly yesterday. Long-term yields plunged. The US dollar tanked against most majors and equities caught some relief. But the fix comes with a catch, obviously. So welcome to Swissquote's Daily Market Talk. It's Thursday, 20th of August. I'm İpek Özkardeskaya, and today I will discuss why the latest news from the US Treasury is so problematic and how it could affect markets in the longer run. But before I do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
You couldn't have missed it. Yesterday was marked by a coup. A coup from the US Treasury Department that suddenly came up and announced that it will at least double the maximum size of its buyback operations to buy more longer-term debt back. Hence, it means that it will have to issue more short-term debt to finance exploding US debt levels, hoping to ease pressure on longer-term yields and accessorily to lower the borrowing cost by issuing more short-term debt at lower yields. The markets reacted heavily to the news. The US 10-year yield immediately fell. It fell 8 basis points, while the 30-year yield dropped 10 basis points from the highest level since 2007. The latter drop in yields helped supporting equity valuations. The S&P 500 eked out a small 0.21% gain yesterday, but the operation remains still short of reversing the chip rout. VanEck Semiconductor ETF lost 1.55% regardless. Then in the FX, the US dollar tanked big time, letting the major currencies and gold rally aggressively. This morning, we see US bonds and FX consolidate as investors question what does the Treasury's announcement yesterday really mean, and what could be the longer-term impact on US debt and broader financial markets? So first, it's important to note that the US national debt crossed the 40 trillion US dollar mark. So the news didn't just come suddenly, it came as the US national debt crossed the 40 trillion US dollar mark. That's a huge level, and this country should pay interest on this debt, and the net interest payments on that is now the third biggest expense in the US. Also, the US now borrows money to pay interest on existing debt, and the fiscal policy under Donald Trump is not coming out well. Instead of restricting fiscal policy and raising taxes to narrow the gap, the Trump administration favors lower taxes and try to fill in the gap by spending cuts and tariff revenues. This is why we could also see the tariff jitters heat up in the coming days. As such, the US fiscal picture today remains as murky, if not murkier, as yesterday, but the way the government is now willing to finance its debt and the weight of the Federal Reserve, the role of the Federal Reserve in this picture have changed. In the short run, the impact is relatively straightforward, as we saw yesterday. The move leads to flatter yield curve, and the easing pressure on longer-term yields helps households with mortgages financing and corporations with borrowing costs that also come lower. So that's a positive development. This is why the equities reacted positively. For the US dollar, lower long-term yields are initially negative, obviously, as they reduce the attractiveness of US assets to international investors. So that's also why the US dollar sold off so aggressively yesterday against major peers. But in fine, if you're looking fundamentally, this operation changes the maturity of the US debt, but it does not change the amount of debt that the US has. More short-term borrowing means lower yields because the yield curve is ascending, but it also means more frequent financing. And if rates remain high, this is where you've got to get the Fed to play along. The government's interest will adjust more quickly, so you need to get the Fed to play along and keep the interest rates low. And this is where longer-term risk lies. If investors conclude that Washington is increasingly trying to manage long-term borrowing costs rather than addressing the fiscal deficit itself, and if they believe that the Fed is no longer pursuing its mandate goals, meaning inflation and employment, but it is pursuing the government's political goals instead, well, they could eventually demand a higher term premium to hold long-dated US Treasuries. So that's a big problem. In terms of Fed, well, Fed looks like it is really becoming a sock puppet in this scenario to the White House to keep the interest rates as low as possible to tame the pressure on the short end, hoping that it will also tame the pressure on the longer end, but the Fed would lose credibility very quickly, and if that happens, it will fail to control the short end of the yield curve effectively. So in summary, the Treasury may have found a way to buy some time to ease the pressure on the longer end of the US yield curve today, but the latter will not solve the problem. Near term, the move will certainly cap the long-term yields and weigh on the US dollar, but in the longer run, without fiscal consolidation in the US, the latter move will not eliminate the exploding debt risks nor the positive pressure on the entire yield curve. The latter, along with the loss of appetite for the US Treasuries altogether, should continue to weigh on the US dollar and on the US dollar structurally. Looking elsewhere, well, inflation figures from the Euro area and the United Kingdom yesterday painted an unideal picture that probably added to the positive pressure for the Euro and for the sterling against the US dollar. In the UK, the producer prices fell in July due to the retreat in energy prices, but consumer prices came in hotter than expected by analysts, as a 13% rise in the energy price cap just boosted inflation for the households. Across the channel, the Euro area inflation figures printed numbers that didn't match the European Central Bank's inflation goal of 2% either, and worse, they are expected to move higher in the next reading in the coming months, as the July energy price retreat that we saw due to the easing Middle East tensions by then proved temporary, with no easy resolution in the Middle East in the coming weeks. So inflation numbers are poised to move higher. The latter is adding to the hawkish expectations from both the European Central Bank and the Bank of England. But here, because the growth outlooks diverge, well, the impact on euro and sterling will not be the same. So if we compare the US, the UK and the euro area and the central bank's policy stance regarding inflation, well, the European Central Bank stands out as the most disciplined central bank for controlling inflation. The Bank of England, on the other hand, would also avoid an overheating in inflation, but the problem is that the UK's economic outlook remains very much dull today, despite surprisingly stronger than expected first half of this year. The weak jobs data that was released earlier this week in the United Kingdom actually came as a warning that Burnham's pending first budget and the Middle East energy headwinds made the Bank of England less likely to act as roughly as the European Central Bank to fight inflation in the UK, because the growth outlook is very much vulnerable. And as per the Fed, well, yesterday's FOMC minutes actually showed that some Federal Reserve officials favored raising the interest rates if inflation didn't decline. This is how you would react as a Fed official, right? But the Fed's reaction function to inflation and its policy goals are getting cloudier by the day, as we talked earlier in this episode, under its new chair, Kevin Warsh, that may be pursuing other and more politically driven objectives than inflation and employment per se. And that makes the Fed's outlook very much uncertain today, more uncertain today than yesterday. So if you list the US dollar, euro, and sterling in terms of the expected discipline of their central bank's monetary policies and their valuations, I would say that the ECB keeps the top position, followed by the Bank of England and the Fed, and the latter should keep the euro and sterling bid against a broadly unloved US dollar, and the euro well bid against sterling as well. Elsewhere, gold, that has come under the pressure of rising global yields since August 10, also has potential to extend its gains if the pressure on the longer term yields remains contained, at least for a while. And gold remains very much interesting for portfolio indeed if global risk sentiment worsens and encourages capital into less riskier assets such as gold. So if we summarize all this, in the very short run, while shifting allocations towards sovereign and corporate bonds, especially corporate bonds, was very interesting recently, it makes sense. It makes sense for a while. Tips in this configuration looks increasingly interesting to me, offering investors exposure to still attractive real yields while providing some protection against inflation risks that conventional treasuries do not address. But again, I would still maintain an increased exposure to gold in this actual environment to give my portfolio a hedge against inflation, the sovereign debt risk, and the geopolitical risk as well. They're all looming on the background today. So this is all for today. I'm İpek Özkardeskaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.